Welcome to this technical analysis insights video. Today we're going to look at the Nasdaq Index and compare it at a fundamentals level to the S&P 500 and also to something you may not already know about, which is called the Shiller Index, and particularly the Cape Shiller Index. I'll be describing that in a bit more detail. And then we'll move on to comparing the Nasdaq to some investment trusts that look at technology companies in the US. Hope you enjoy it. So let's get to it. This is the trading view chart for the Nasdaq Index, and I've got it on the monthly scale. And that's because I want to show you this index on a longer time frame. When you're looking at indexes, my experience is that longer time frames are much better to look at what may be going on, because you can get lost in the woods if you're trying to look at it on an hourly or a daily basis, unless of course you're a day trader and you're trying to make a few points here and there. But if you're an investor and you're comparing the technology index or a technology trust or a fund to that technology index, then a longer term time frame is advisable. So this blue line represents the closing prices per month for the Nasdaq, and what you can see is it's had a significant bull run all the way from the 2008 crash. There was a hiatus when we had the dot-com boom in around 2000 that all came crashing down in tears, and then picked up slowly. And then we've had a massive technology boom in the last few years. And I suppose the question on everyone's mind is, can it last? And that's what we're going to look at. Now, to begin to answer that question, I typically look more broadly, and I specifically look at an index called the Shiller Index. Shiller was a very famous professor at Yale University. He won an economics Nobel Prize for this particular work in terms of coming up with an index which reflected more accurately the state of the market over the long term. You can see in that sort of middle paragraph on the page that his definition that he uses was inflation adjusted earnings going back over the previous 10 years. That's why I call it the cyclically adjusted PE ratios, CAPE for short. The interesting thing is, if you look at it for the S&P 500, which is this chart at the top, you can see that the CAPE ratio for Shiller currently is at an all-time, well, near to an all-time high, barring the dot-com boom and barring a rise effectively just about early last year, when tech stocks, as a result of COVID, moved significantly ahead and drove everything up. Black Tuesday was the Great Depression in the late 1920s, and currently we're around the same level as that in terms of aggregate sentiment in US markets. So that's very interesting, because you have to ask yourself, well, does that bear further investigation, and is that reasonable? Clearly we're in a completely different market to where we were between the two world wars. It's a completely different state of affairs, and companies do have longer runways in terms of revenues. Question is, how long? Now, I'm sure I don't need to introduce this to you, but one of the key ways that companies are valued is on their price earnings ratios. And so CAPE does it for S&P 500, but CAPE is also subdivided into different sectors, as you can see here. The technology sector at 34, and this was data going back to the end of last year, at 34, I think currently it's 31 for technology, is amongst the highest in the aggregate market. So that's price earnings. Earnings being profit in simple terms, or net income, depending how it's defined, with or without amortization, etc., etc. But generally, let's just think of it as profit. It's certainly not revenue. So the question is, what's going on in the Nasdaq right now, and is this 34 actually the real ratio? I think most of us will be aware. This is the NVIDIA chart, and I'm just using that as an example of what we're all aware, which is that the Nasdaq is heavily influenced by 7 artificial intelligence focused companies. And those 7 are driving the entire Nasdaq to ever increasing heights, as you can see here. And this is simply NVIDIA, which has been on this incredible bull run since the beginning of this year. NVIDIA is, and indeed the other AI companies, but NVIDIA in particular is, I think, takes your breath away. It has a market cap, as you can see over here on the fundamentals tab of TradingView, of just over $1 trillion. Its annual revenue is 26, shy of $27 billion. So on a revenue multiplier, it's close to 40 times. The income is what is quite staggering. You can see here the net income for last year in 22 was $4 billion, and it has a market capitalization of $1 trillion. That puts it on a PE ratio of 250. I'll say that again, 250. So when we were looking at the CAPE ratios, we were looking at CAPE ratios for the tech sector at just over 30, 31. NVIDIA is on 250. And I suspect if we looked at the other 6 AI focused companies, we'd see similarly outrageous valuations. So how does that happen? Well, that's all to do with sentiment. Everything in here is sentiment driven. It's certainly not fundamentals driven. You couldn't possibly say that you could forecast with any accuracy that a company will still be around in 250 years time. That's what PE ratio means. It means that the valuation of a company is being forecast to how long it may generate those profits into the future. 250 years for NVIDIA, that doesn't make any sense on any metric whatsoever. So the only reason it's going up is sentiment. So back to the Nasdaq chart, and let's have a look at how that compares to the S&P 500, which of course has none of the AI companies in it and is the general sort of bellwether for the US economy as a whole. In TradingView, you can have, with this little plus sign, comparators, and I've already preloaded the comparator for the S&P. And that's the S&P, and I'm taking that from the beginning of data on TradingView, which is 1985 for both. And you can see that the S&P in effectively those 40 years has gone up 2,400%. The Nasdaq post, shall we say, the great crash of 2008 has gone up from roughly being comparable to the S&P to 1,200%, effectively a 6 times, well, it's 5 times improvement over the S&P 500. All of that driven by just a handful of companies. Is that driven by fundamentals? Can't possibly be, not with those types of PE ratios. So it's only sentiment. The question is, how long does that sentiment survive? So far, it survives a long time, and I suppose it's because when you're running a fund, you can't ignore that the sentiment is so strong, and so you continue to buy until there's something that shows you something different. Let's look at a particular example. This is the Polar Capital Trust that invests in the US technology sector, and which is you can see here in red, and you can see in the same time frames, well, the Nasdaq has done quite a lot better, but that's not the whole story. When you change the viewing range and you start Polar Capital actually at the point at which it started it was created, which is about the beginning of the century, in the year 2000, then in fact Polar Capital has virtually tracked and mirrored the Nasdaq completely since its inception. If you actually take the range a little bit nearer in perhaps the last 10 years or so, since 2013, Polar Capital still is about the same level as the Nasdaq, but there was a period of time when it was slightly ahead. So when you're looking at trusts, make sure that you're looking at it from the period which most interests you. Now, if we look at another fund, and this one is called Bailey Gifford, they themselves were created in around 2018, and you can see, well, that's not performed perhaps as well as Polar Capital as far as the technology trust is concerned. But if we change the time frame to when it started, you can see that there was a period of time when Baillie Gifford was completely off the scale, i.e. it outperformed the Nasdaq and indeed Polar Capital and the S&P by a significant margin. It came crashing down, and albeit that the Nasdaq has gone up since effectively the beginning of this AI craze, it seems that the guys at Baillie Gifford didn't buy in to these huge PE ratios that the AI companies, the big seven, shall we say, are now valued on, and they perhaps chose, and I don't know, their fund to be composed at a fundamentals level of companies which they thought would do better, at least from the fundamentals perspective. In the meantime, sentiment has moved ahead, and people continue to buy regardless of the valuation, purely on sentiment. The guys at Baillie Gifford don't believe in that level of sentiment, although they've begun to change their tune a little bit more recently. So we see here that you have two different styles. You have one fund that is effectively mirroring an index and possibly mirroring the level of sentiment. The S&P is doing its own thing, and you've got some fund managers here who are taking a contrarian view that those valuations in the big seven are not sustainable. Where will it go next? For me, until I see a discernible change in trend, this trend is going to persist. There's nothing on this graph here that says it won't persist. We had a little bit of a downturn post-COVID when effectively, shall we say, in tech stocks, because of COVID and everyone working from home, all the tech companies did well. That sort of stopped, and now this new wave is all about artificial intelligence. When will it stop? When will it come to a grinding halt? At the fundamentals level, it should have come to a halt ages ago. Sentiment is saying no for now, until I see technical evidence on an analytical basis to the contrary. That sentiment continues to run. I'd see no reason why it wouldn't. The takeaway I'd have from this video is that sentiment trumps fundamentals, and the only way oftentimes to see a change in sentiment is by using technical analysis. That will help you to see it in advance. In the meantime, it's probably important to go with the flow, as it would seem with the Baillie Gifford and Polar Capital example versus the Nasdaq. Anyhow, I hope that you've enjoyed this video, and I'll see you on the next. Cheers.